Hi everybody, my name is Michael Toy. I am with KeyPoint Credit Union's Wealth Management Division, and I just wanted to welcome everybody to our seminar today. Our seminar is titled Tax Matters, Tax Management Strategies. So thank you so much for coming and joining us today. It should only be about 30 minutes or so. Obviously, if you have any questions, feel free to either raise your hand in the raise hand button on the Zoom, or you could also type your question into the chat, and I'll try to answer them as they come along. We'll try to have a question and answer at the end as well, but if anything comes up, I'll just take it at a leisurely pace here. And if you have any questions, feel free to go ahead and ask them. This is really just for you guys and for our members here at KeyPoint Credit Union. So let me just go ahead and get started here. So just want to let you know that the KeyPoint Financial Services group is really just made of, well, 4 people. There's 3 financial advisors, myself, Michael Toy, Eaton Vision, who is also on this call, and Jimmy Suh. He is also an advisor here at KeyPoint Credit Union as well. Even though we all work for the same company here, we are assigned to different offices. So, you know, usually we're stationed at different offices. Now with the pandemic, of course, a lot of us are working from home or remotely, but I am typically in the offices of Cupertino and Milpitas. Eaton is typically in the Bowers, Brokaw, and Dublin offices, and Jimmy works out of our office out in Goleta in Southern California. And I just wanted to see if I can show you real quick a little bit about us as well. Let's see here. Let me share my screen. So this is our KeyPoint website. We do have a KeyPoint Financial Services website, just to let you know it's part of the KeyPoint Credit Union website. And let's see if I can show. It's not working so great. Here we go. That's my picture there. That's a picture I took 6 years ago, so I look a little younger there, a little less gray. That's Eaton there, and that's Jimmy. And of course, Mona. Mona's our administrative associate. So Mona, thank you so much. She's running this seminar right now. So that's the 4 of us right there. So let me go back to the presentation at large. All right, so if you ever need to find us, you can go to our website and you can look us up. Our email and our phone numbers are there. And hopefully, if you had any questions, feel free to ask us in the future. All right, so I will skip that, already did that already. Okay, so what is 2021? What sort of changes are being made so far this year for the tax season? So first of all, tax day is now May 17th. And that's for federal and for California. Now, if you're in a different state, they may have different rules for your state, but here in California, it's May 17th. That was extended from April 15th. They decided to make it another month later, I think because of what's going on with the coronavirus right now. So also what changed was our IRA contribution deadline was extended to May 17th as well. So if you were going to make a contribution to an IRA or a Roth IRA or a SEP IRA, you do have a deadline extended to May 17th. Other big changes for 2021 was a standard deduction increase. So for those of you that uses a standard deduction, that did increase. Obviously, if you itemize your deductions, that's different. Another change was the income tax bracket inflation adjustment. So there's been a bit of inflation from 2020, and then the required minimum distribution is back for 2021. So last year, if you were someone that had to take a required minimum distribution, you actually didn't need to. So that was nice, but they're back for 2021. All right, so here's an interesting fact. The wealthiest 87% of wealthiest 20% of taxpayers pay 87% of all the taxes. That's an interesting fact. Also interesting to know that most of us, what do they call the top 20%, is people who make about $120,000 or more. Now you may think to yourself, well, that's not that much money, especially here if you live in Silicon Valley, California. But the average income for a household in Santa Clara County, now I know we're all from different counties around here, but the average household income for people in Santa Clara County is about $124,000. So even though you make an average or median salary in Santa Clara County of $124,000, you're considered high income compared to the rest of the country. Now that may seem unfair, but our cost of living is a lot more expensive as well. And with that, our poverty level household income for Santa Clara County is actually at $94,450. Just pulled that off the website this morning. So interestingly enough, you may be considered one of the people that pay the most taxes in the United States, in the top 20%, but you may not feel like it because you live in Santa Clara County or another adjacent county like Alameda County or Santa Barbara County, where your median household income is, not that much when you consider all the cost of living. On the other side of the equation, the bottom 80% of taxpayers pay only about 13% of all federal income taxes, and the bottom 20% actually have what they call a negative tax rate, which means they actually get more back from Uncle Sam in the form of refundable tax credits than they actually pay in taxes. So also another fact, when top 1% of people, of all top 1% of households, the top 1% pay more than the bottom 90% combined. So it's a pretty crazy stat when you think about that. All right, the tax burden on people. So Americans face many types of taxes. We all know about federal income taxes. Federal government also levies Social Security and Medicare, which are usually taken out of your paycheck, and gift and estate taxes. Now, with Joe Biden as our new president, he's been talking about a lot of different tax reform. One of the biggest ones he was talking about was estate taxes. Obviously, nothing's under fruition yet because it has to go through Congress and the Senate. But he was talking about increasing, especially the estate tax for exemption. I know that a lot of estate attorneys are talking about that right now. So it's important to make sure you have a plan in place, especially if you're going to be doing any sort of estate tax planning, but taxes in general. Then there's also state taxes as well. So not only is there federal taxes that might be changing, but the state taxes. So sales taxes, gasoline tax, tobacco, alcohol, other products, and local governments can make taxes as well. I live in a city that just raised their sales tax 0.25% on the last ballot. And, there's nothing I can do about that really, but it's just something that, that every dollar that you make, some of it will go to taxes. So kind of the point of this conversation is to avoid those taxes. All right, next slide is the impact of taxation. So if you were to get an average annual stock return of about 10.2%, which is pretty average return for the last 94 years, most people on average would take home only about 8.2%. That's about a 20% difference. And that's what's called the tax drag. Tax drag is what are you actually taking home on your investment, not what you're actually earning on your investment. So you have to consider, even if you get a CD at whether KeyPoint or your local bank and you're making 1% off of that, you're not actually earning 1% because what you take home is what you get taxed on that, or what you get after taxation. So for most people around 22%, that's probably an average marginal tax bracket around here. Plus you got to realize there's state taxes as well. So there's usually a tax drag on there. So it's important to think about the taxation of your investments, not what you actually make, but what you actually take home. All right, next slide, the rules change. So one thing that's pretty much a constant from 1940 till 2020 is the amount of new tax laws that have come into place. And that's probably always going to happen. They're not probably going to take away too many tax laws. They're probably going to always add new tax laws. So one thing that I think will probably happen in the future is there will be new tax laws that will be put into place. It's really important to know that, again, that the taxation on your investments is going to be a tax drag in the future. Okay, next slide here is tax change investing. When we talk about how to avoid taxes, they usually fall into two different categories here. One is tax exempt investments. So that would be something like municipal bonds and money market funds. So municipal bonds are bonds issued by municipalities, typically the federal government or the state or a local municipality like a county bond. And those are tax-free from both, well, if it's a California bond and you're a California resident, it's tax-free from both a federal and state standpoint. Those are extremely popular, especially for those people who pay a lot of money in taxes and are in high tax brackets. They want to avoid paying federal and state taxes. The other thing that is very popular is tax deferred investments. Tax deferred investments would be things like qualified retirement plans, such as IRAs and employer plans like 401ks or 403bs. I always recommend to my clients that if you have a 401k at work, especially if there's a matching, to always, or if you can't afford it, to put money into your 401k. And if your employer matches it, that's basically free money they're giving you. So there's almost no reason why you wouldn't want to do that, in my opinion. The other would be annuities and life insurance. So annuities and life insurance are other tax deferred investments. Annuities are, well, we'll get into that and what annuities and life insurance are, but that's the other one as well. I'm trying to think, was there a question here? I thought I saw something blinking on my screen here. Maybe, I can't tell. All right, well, I'll just move to the next slide here. The next slide is about the municipal bond market. So we have a 3.9 trillion municipal bond market out in the whole entire United States. So California obviously is one of the bigger states here in the United States. So there's a huge municipal bond market for California bonds, especially. California is also one of the highest tax states in the United States as well. So it's extremely popular, especially amongst people who make a lot of money here and for people who just make a moderate amount of money as well. So you don't have to be rich to be in the municipal bond market. Like I said, if you make $120,000 a year, you're considered one of those high tax people, even though you may not seem like you're a high income household. So a 3.9 trillion municipal bond market. Yeah, so you can see the statistic there. So that's a very popular one. If you buy a municipal bond, like I said, you don't have to pay federal or state taxes. So if you're in a 22% federal tax bracket, plus on average here in California, about a 9.1% California bracket, that's over 30%. And if you make a lot more money than that, it's not uncommon for you to be in a 25, 30, 35% tax bracket for federal taxes. And if you add in California taxes, it could be almost 50% of your money. So like I always say, it's not really what you make, it's what you take home. All right, so municipal bonds. There are two ways to buy municipal bonds. You can buy the actual individual bonds, and that's kind of, you know, where you go in, it's kind of the old fashioned, what they call clipping a coupon. In the old days, they used to have bond certificates and there was literally a coupon you would clip and you would turn it in and you would get that income payment. So while people still buy individual bonds, kind of the way that most people buy bonds nowadays are through mutual funds, bond mutual funds. So one of the biggest issuers out there, or the biggest companies out there, is Franklin Templeton. It's just not advertisement for Franklin Templeton, but they do have the biggest California municipal bond fund out there. It's about 15 or 16 billion dollars. It's about 7 times higher than the next municipal bond fund out there. For California bonds, they have more analysts than the state of California does. So they are a local company too. They are based out of San Mateo. And I'm not trying to shill it, but like I said, I used to work there, so I kind of knew a lot about it. But you know, there's benefits to owning different individual bonds versus bond funds. You know, you will save a little bit of fees if you buy the individual bonds. And if that's something you want to do, that's something that, you know, we could help you out with. But the mutual funds, they do offer diversification, liquidity, low minimums, and professional management, but there are typically some sort of fees involved with buying the mutual funds, whether it be the fund expense charges, which is just the expenses of trading, management, and trading fees of the bonds. So there are other fees involved, but it's a lot easier to buy mutual funds, bonds through mutual funds. So, you know, all of us that are financial advisors here at KeyPoint, whether it be myself, Eaton, or Jimmy, you know, we could definitely help you out with either one of these individual bond portfolios or bond mutual funds. Very popular way to buy mutual funds. In fact, it's probably one of my top sellers. Okay, taxable equivalent yield. So taxable equivalent yield just talks about how much are you earning on a tax exempt bond versus a taxable bond. So if you're in a marginal tax bracket, so in this example here, they did show one of 32% here. And if you got a tax exempt yield of 6%, which by the way, if you can find a 6% bond right now, congratulations, because there's no way you're getting a yield like that right now. But in this example, if you had a 32% tax bracket and you were getting 6% tax exempt yield, that's the equivalent of an 8.82 taxable equivalent yield. I think there's a question here. If you buy municipal bonds, can they be deducted from income? Now, they're not deductible as income. What it is, when it shows up on your 1099. So somebody asked, if you buy municipal bonds, can they be deducted from your income? They're not deductible. The way they work is when you get a 1099 at the end of the year on your tax return from the issuing bond company, then it'll show up as either a qualified or exempt interest. So when you do your tax, it's reportable. I mean, you'll have to report it on your taxes, but it's not taxable. Hopefully that answers that question. So I see some more questions here. Is life insurance tax-free? Yes, that's one of the things that we're talking about, and I'll get to that here in a little bit. And money market funds tax exempt. Yes, that was part of that as well. So yes. Okay. Sorry if I missed those questions earlier. For some reason, they didn't show up on my screen until now. Okay. So people are probably asking, what kind of yield can you get right now? You know, I did say earlier, a 6% tax exempt yield is not something you can get right now. Realistically, it's in the 3 to 4% range right now, just because of where the yield curve is right now. I'll show you a quick thing here if I can show it on my screen. What was that? So this is about the federal funds rate. I had this up earlier. So as you can see on my screen here, the federal funds rate is set by the Federal Reserve, and they just met last week, I believe, last week or 2 weeks ago. They're talking about, you know, this is the rate that the federal government sets for the Federal Reserve to lend out to banks and credit unions and things like that. So this is historically over time how the rate has changed. So this goes back to 1955, where it was at around 0.8, to the 80s. If you guys remember what happened in the 1980s and the early 80s, you could buy bonds for like, 10, 15%. You can get a municipal bond for the next 30 years. That was crazy for any of you that remember those times. To the 2000s over here, this is 2007, right before the crash, 2006, 2007, right before the crash. And then you guys remember the crash in 2008. And then this is what Obama did. He basically cut, or the Federal Reserve under Obama, they cut the reserve rates all the way down to close to zero. And it basically stayed at zero until about 2016. Donald Trump came to office. They raised it up slightly, and then the pandemic hit, and then it went all the way back down to June of 2020, at least according to this screen right here, or sorry, January 2021 at 0.09. So I don't need to tell you that it is at pretty much an all-time low right now. And that's why it's a great time to borrow money. It is not a great time for savings vehicles like CDs and savings accounts, whether at KeyPoint or anywhere for that matter. And I'm not saying, not picking on KeyPoint, I'm just saying that it's not great anywhere. If you go to, I sell a lot of, or not sell a lot of, but I talk to people a lot about CDs. A 1-year CD at KeyPoint is earning 0.5% right now. And you say, oh, that's terrible. But if you were to go look out into the whole entire universe, if you were to go to bankrate.com and try to find a 1-year CD somewhere else, you'll find out that's actually pretty competitive right now. If you were to go to Wells Fargo or B of A, congratulations if you can even get 0.1% right now. Okay, so let me go back to the slideshow here. All right, next slide, qualified retirement plan. So IRAs and 401ks and 403bs. So right now, you can do an IRA contribution according, if you can hit the income limits, it's tax deductible. And I'm not gonna go over that right now, but the maximum contribution is $6,000 and $7,000. If you're 50 plus, you can do what they call a catch-up contribution. Also, there's a 401k and 403b. Like I said earlier, if you work, 401k is for private sectors and 403b generally for government or state workers. So there's a contribution of $19,500 and $26,000 if you're 50 plus. Definitely recommend those. The way qualified retirement plans work is you put your money in, you get to reduce your income. So if you're doing a 401k, it's automatically deducted from your income, or 403b. So your taxable, your adjusted gross income is actually reduced. So if you have an income of $100,000, you put in $5,000 into a 401k, you're being taxed at $95,000, roughly speaking, instead of $100,000. And for IRA, it works kind of in reverse. You actually claim it on your tax return. So if you make a $5,000 contribution to your IRA, you reduce your taxes from $100,000 to $95,000, and you get that deduction on your taxes. For IRA, here's a question from an anonymous attendee. For IRAs, it is less beneficial to contribute for higher salaries for taxes. So there is a, okay, so for the first question here, for IRAs, it is beneficial up to a certain amount. So there are tax, there are income limits where it's deductible for an IRA. I will say you should talk to your tax person about that with the IRA. I mean, you can Google it and look it up, but I think it's, I mean, I'm just spouting this offhand. I think for married couples, it's around $140,000 for income right now to make a deductible. You can always make a contribution, but to make it deductible, it has to be up to a certain income level. You can look it up online. Next question here, can you make a contribution if you are unemployed? So actually depends. You have to have household income. So for example, if your spouse is working and you are not working, you can make a spousal contribution to an IRA, and it's up to the amount of whatever, I mean, 5,000, 6,000, 7,000 for IRAs. But also you have to have that much, at least that much income as well. So if you don't make $6,000 or $7,000 in income for that year, like if you only made like $3,000 or $4,000, you can only contribute $3,000 or $4,000. You can't contribute more than you actually made. So there you go. Okay. Let's see here. Okay. Okay. Next slide here. Okay. Qualified retirement plan advantage. Okay. So if you have $1,000 in pre-tax earnings and you invested $1,000 versus $1,316 pre-tax earnings, you take out $316 for a 24% tax rate versus $1,000. So more questions. Let's see here. Someone private messaged here. Let's see here. If I have a question on a backdoor Roth IRA. How many days do I need to keep the money in non-deductible traditional IRA before I roll over to a Roth IRA? Okay, so if you have a Roth IRA, how many days do I need to keep the money in non-deductible Roth before I roll it over? Trying to see, I don't know offhand. I know there's typically a 5-year plan for Roth IRA to take money out without taking the interest out. You can do, but I'm not 100% sure on that question right there. So sorry, I could try to take that offline. And the second question for 401k growth or traditional, how to go about. I'm not sure what growth versus traditional means, but maybe you're talking about traditional versus a Roth 401k. So a Roth 401k is post-tax money versus a traditional IRA, which is pre-tax money. I am a big fan of Roth 401ks. So if that is available through your employer, I do recommend that. It just means that that's post-tax money going in, and then you've already paid the taxes on there. So versus a traditional IRA, which is pre-tax money going in, when you take it out, you have to pay the taxes on the way out. So I think that's the question, but I'm not sure what growth versus traditional means. More questions here. Oh, that was a question. Okay. If you need to follow up a question, go ahead and type in your question to the chat. Hopefully that answered some of that questions there. Read something else here. Okay, so back to this slide here. When broken down, the advantages of qualified plans, retirement plans, are significant. In this example, $1,000 contributed to a 401k plan. Contribution is made with pre-tax dollars, which has the potential to add up over time. So an investor that was in the 24% tax bracket, that person would have to save about $1,316 to contribute the same $1,000 in another type of savings account. So again, that's going back to tax drag and talking about how, taxation is incredibly important. Okay, next slide. All right, take advantage of tax deferred options, contribute as much as possible to employer sponsored plans. Of course, I always say that with the caveat, as long as you can afford it. Obviously, if you're living paycheck to paycheck and you're not sure if you can make the payment for the rent, then maybe you don't want to do as much as possible, but it is much as possible. I definitely do think that's a great idea. And then consider contributions to an IRA or a Roth IRA. Roth IRAs also are subject to income limits as well. So if you make too much money, an IRA or a Roth IRA would not be a great option for you. And your best plan may be the 401k or 403b. All right, types of annuities. So the other thing that we're talking about for tax deferral are annuities. There are two kinds of annuities. There's what they call deferred annuities. Now, deferred annuities is where you put money into with an insurance company, and there's an accumulation phase where the money will grow. So usually there's different ways to accumulate money. Some have fixed rates. They're called fixed annuities. Some have what they call index annuities, which are indexed versus an index such as the S&P 500. And so they're linked up against those indexes, and they usually have some sort of agreement where you cannot lose money in those because they are accumulation ones. They have guarantees that you won't lose money. Another kind of annuity is called deferred annuity is called a variable annuity, which are put into variable types of investments like stocks or bonds or mutual funds. And then on the other side of that hill, when you decide to retire, there's a payout phase. And the payout phase is when you basically take money out and you're trying to live off of a fixed income at that point. So that's the deferred annuity. The immediate annuity is when it's more the traditional, how people think of annuities, where you put a lump sum in there and the insurance company will pay you a lump or a fixed amount every month for the rest of your life. And those things still do exist, or more thought of as a pension. Deferred annuities are also very popular nowadays as well. Question here. Why would anyone ever want to not use a Roth 401k given the fact that taxes will go up over time? Like I said, if you have the option for a Roth 401k, I would typically do it. I would say maybe not so much if you are closer to retirement. Would you not want to do that because you are, maybe you want to reduce your income now? So for example, if you're in a high tax bracket right now and you want to put money into a traditional IRA, that will reduce your income now. So I think if you are closer to retirement, maybe a traditional IRA might be better for you. But if you're young, if you're in your 20s, 30s, 40s, even 50s, I'd say a Roth 401k is a pretty good deal. If you're in your 60s, maybe not so much. Typically, those people are making a lot of money. It's what they call your golden years for making a lot of money. So maybe you wouldn't want to do that as much, and you'd want to, reduce your taxable income to either reduce your tax bracket. So that's one case where I think that might come into play. All right, next question. Is there any income max to prevent you from opening a Roth 401k? Let me just double check that. I'll check that and I'll get back to you. I don't want to stall the whole meeting right now. I'll answer that one later. Okay, make it to the next slide here. Okay. All right, an annuity strategy. So going back to the annuities here, here's a strategy where someone had $100,000, and let's say they took the $100,000 and they split it between $50,000 between a fixed annuity, a deferred fixed annuity. Let's say it was earning 3% per year, and then took the other $50,000 and put it into an immediate annuity. So the $50,000 over 10 years would accumulate at 3% per year to $74,110 after 10 years. And the income annuity would give you an income of $250 per month, essentially for the rest of your life. So what's interesting about this strategy is that after 10 years, the annuity would build up to $100,000 again. And the other half of the annuity would give you an income base of $250 a month. Let's see, was there another question? Can you set up a Roth 401k for a kid? So the kid has to be employed. That's the first question. So that's the first issue. So they would have to be working. And the answer is, I actually have seen that before. I think there might be an age limit. I don't think they could be like, I think they have to be, 16. I don't know offhand what the age is, but the answer is yes, and I have seen it before. I think if the other question is, can you open a Roth IRA for a kid, not a Roth 401k? The answer is yes to that as well. I have set those up before. But like I said, the kid has to have income. That's the main issue. So if your kid is not working, then that's not something that they can be done. So if the kid has like a summer job and they're like a teenager and they're working, you know, a summer job or something like that, they can definitely do that. But if you have like a 2-year-old or a 3-year-old, I don't think that's something you can do. I'm sorry. All right, next slide here. Okay, can you hold an annuity in an IRA? Yes. I think one of the top questions that people have about holding an annuity in IRA is that an annuity is already tax deferred. So why would you hold an annuity in an IRA? The answer is because of the benefits that some annuities have. A lot of annuities have guarantees. So they have guarantees that you won't lose money, for example. So a lot of them have rates you can get where they're like a fixed rate, like similar to like how a CD works, but they also have variable rates or index rates, which is actually probably the most popular one, which is like a variable rate with a downside of 0. So that's a way of making money in a fixed indexed annuity without losing money, and putting in an IRA happens all the time. There's also death benefits and lifetime benefits, like income guarantees that you can put into an annuity, even if it's in an IRA. So there's definite benefits to doing that. Also, there's considerations of there's no additional tax savings, of course, because it's already tax deferred in an IRA. And then the cost. Some annuities do have costs of them, and that's definitely a consideration. And that's something that myself or another advisor here at KeyPoint can definitely go over with you. Okay. Life insurance. So we're gonna go over the cost of life insurance, cash value, and life insurance itself. Let me just get to that slide here. One moment. Okay. Another tax deferred possibility is a cash value life insurance. With a cash value life insurance policy, and an individual purchases a policy from an insurance company. In exchange for the premiums, the insurance company promises to pay a set benefit when the policyholder dies. These life insurance policies also build up a cash value, effectively a cash reserve that pays a modest rate of return. The growth is tax deferred. Most whole life insurance policies will let policyholders borrow a portion of the policy's cash value under favorable terms. And interest payments on policy loans go directly back to the policy's cash value. This option can be good for someone that needs steady, secure cash reserve and are happy with a modest rate of return. Several factors will affect the cost and availability of life insurance, including age, health, and the type of amount of insurance purchased. Life insurance policies have expenses, including mortality and other charges. If a policy is surrendered prematurely, the policyholder may also pay surrender charges and have income tax implications. One other popular thing with life insurance nowadays is a rider called long-term care. So if any of you ever taken care of an elderly person before, or ever have to deal with long-term care insurance, that's something that can be added as a rider to life insurance policies. That's a very popular thing nowadays. It's a little bit off topic because it's not talking specifically about the tax benefits and everything like that. Long-term care is a really important thing that I know a lot of us advisors like to talk about nowadays. It does exist. I'll just say that it does exist, and you could use the death benefit that would normally use for a death benefit in your long-term or your life insurance policy for long-term care needs instead. So if any of you want to learn more about that, feel free to ask me or one of the other advisors here at KeyPoint. How many life insurances do you recommend? So KeyPoint Credit Union is a broker dealer, meaning that we don't represent one company. It's not like we work for like MetLife or State Farm Insurance. So we don't act as an agent, we act as a broker, meaning we will shop many different life insurance companies out there. So we do have partners that we deal with, and it's fluid, meaning sometimes rates will change and we'll figure out the best provider out there, the lowest cost versus, not lowest cost isn't always the best one. Sometimes you might find a provider that's has a better reputable, name or service or insurance rating as well. So usually when people come to me and they want to buy life insurance, I'll usually come back with the top 2 or 3 quotes that I come back with. So it depends upon, you know, the person that I'm trying to insure. And, you know, some insurance companies will have different rates depending upon, you know, just what kind of deals they're having out there right now versus, you know, what they consider high risk. Like if you come back as a standard versus preferred rating, or if you're trying to buy, you know, a 10 or a 20-year life insurance policy or a whole life policy, or one with a rider on there such as long-term care or income benefits. So, you know, the question of how many do I recommend, I definitely recommend you shop and you get at least a couple different quotes, but that's something that us advisors here at KeyPoint will do for you. Okay. Next slide. Okay, the advantage of tax deferred, oh, there's another question here. Oh, no, that was it. Okay. Advantage of tax deferred growth. Okay, so, you know, deferring the taxes on an account can make a big difference in the rate it accumulates. Money that would otherwise be siphoned off by taxation each year remains in the account, increasing the potential return. That goes again, talks about the tax drag. For example, if you were to deposit $100,000 into a taxable investment earning 6%, and assuming you're in the 22% marginal income tax bracket, after 20 years, you would have accumulated $250,000. But if you took that same $100,000 into a tax deferred account earning the same 6%, you would have ended up at $320,000. So even after paying taxes, assuming that's after you take the money out, you'd still have about over $265,535. That's a difference of more than $30,000. And I like to say, when you're buying tax deferred investments, whether it's like, especially like in an annuity, it's not so much about, yes, it's definitely about tax deferral, but also tax control. So you control when you take the money out. When you take the money out while you're working, you're in a relatively higher tax bracket, 22%, 25%. But when you're retired and you're not working anymore, and that's presumably when you start taking money out of your annuity, you're probably going to be in a lower tax bracket, 15, 10%. So when you start taking money out, you're controlling when you're going to be taxed on those investments. And that's really important to know, because you could save, you know, 10, 15% on your taxes just by deferring to taking the money out when it's an opportune time for you and your family. Okay, managing your taxes. Effectively managing your tax liability is a lifelong process. Here are some questions that arise at different stages of life. So, you know, you could have, here's some questions that you probably should be asking yourself if you're out there. How do we take advantage of available tax credits and deductions? Should we max out our 401k plans? It's a great question to ask. You can ask us as financial advisors. How do we allocate our assets for the best tax advantages? How can we gift assets to our children in the most tax effective manner? It's a great one for estate planning. There's gift tax laws too. I just had somebody the other day who put a lot of money into her grandchild's 529 college savings account because she wanted to pass a legacy off to her grandchildren. Great way to doing it. Can tax advantage investing help me manage my tax burden? What retirement plans are available for small business owners? I do manage some small businesses, their retirement plan. So we have options out there for small employer-sponsored 401ks to SEP IRAs to simple IRAs. Those are options that us as KeyPoint Financial Advisors can help you. Another question that may come up is, am I realizing all the tax benefits available to me? Are there changes in the tax law that may affect my situation? Again, feel free to ask any of us those questions. And each the answer is dependent upon your situation. And I think after reviewing your investments and your taxes, since tax time is coming up here in the next month, well, not technically next month, 2 months from now, it's a great time to review how much taxes you've paid this year or last year in 2020, and are your investments set up in a tax efficient manner? Are you getting the most out of your 401k, your IRAs? Or should you do a Roth, or should you do a traditional IRA, or traditional Roth, or Roth 401k? Those are great questions, and all of us here at KeyPoint would be happy to talk to you. All of us financial advisors here at KeyPoint. Yeah, and that's pretty much the end of the slides there. So, are there any other questions that anyone wants to ask? I'll stay online for a little bit longer if anyone wants to ask any other questions, but that's the end of our presentation today. If you're gonna log off now, thanks for coming in today. It's about 45 minutes. I guess it took a little longer than I thought, but feel free to drop off and contact us here at KeyPoint. From the whole wealth management team, myself, Eaton, Mona, and Jimmy, thank you so much for attending today. And I'll stay on the line a little bit to try to answer any questions that I can. How do I set up an appointment with one of the tax advisors? So I just want to make real quick, we are not tax advisors. We are not CPAs. We don't do tax returns, but we do investments. So if you're looking for a tax advisor, like a CPA, we don't do that here, I'm sorry. But if you want to set an appointment with one of the financial advisors to review one of the things that we just talked about today, feel free to contact us. There's a website, kpcu.com. Then we are the wealth management department. Feel free to email, call us. Actually, I should probably put up that slide here. Share that real quick. Where was that? Let's see, not that slide. This one right here. Okay, so that's me. There's my phone number right there. There's my email address. There's Eaton. That's her phone number. It's her email. And then there's Jimmy. Over here is his email. And you can contact Mona too. Actually, Mona might even be the best place to start, just because she will, if you're not sure who to go to because you want to meet at, whatever branch, she can figure it out for you. We also are doing a lot of reviews because, we're at home a lot of the times too. We do a lot of reviews over Zoom or Microsoft Teams. We're happy to do that. Okay, so we're very happy on doing that. So thank you for attending. I think that is all the questions we have for now. Any other more?
Hey, Michael.
Yeah, I'm here.
Yeah, can you hear me? There's one more question. Is
there a charge to schedule an appointment with you to answer questions as KeyPoint members? No. So this is a benefit of membership of being a member of KeyPoint Credit Union. It costs nothing to talk to us. So great question there, but it does not cost any money to talk to us. Though I will say, depending on if you're going to buy something like a life insurance or an investment, there could be fees of that, but the consultation itself, there's no charge just to talk to us. Okay, any other questions? Okay, well, I'm going to stop sharing my screen now. And I think I'll just go ahead and end it. Mona, did you have anything? I think that's it. No more questions in there.
Oh, I do see something in the chat.
One more?
I guess not. No. They just said, okay, great, thank you.
Oh, all right. That, ladies and gentlemen, is Boomer. She is our outstanding assistant.
Hello, all.
She's going to New Orleans. She'll have a lot of fun there. TMI, I guess.
Yeah.
All right, well, I'm going to end the call. Thank you so much, everybody, for coming.